Hey, everybody. Happy Tuesday. Thank you for joining us. It is a pleasure to see you all. I see Jen's coming in.
Look at this. Klaus is in
Olivier,
Germany.
Francesco, Rich, Burkhard, Michael. Hello, everybody. Thank you guys coming in. Yeah, let us know in the chat where you are coming.
There you go. Paris.
Where you are coming from. I'm Brian Feroldi. I am coming to you live from the mighty state of Rhode Island.
And my name is Brian Stoffel. I'm coming to you right now from, well, the unseasonably warm state of Wisconsin. I'm in Milwaukee, Wisconsin. And look at this. It's good to see that our YouTube stream is working. We've got lots of folks coming in from San Diego, Ohio, New York City.
Love it.
That's awesome.
Love it.
Hey, and X2. Look at this. We got people coming in through X.
I do want to let people know I'm not a huge Christmas fan or Christmas guy, but last year I did buy this shirt, which says Merry Christmas. It's not Christmas until Hans Gruber falls from the Nakatomi Plaza. And all I'll say is, if you know, you know. My trivia team has we have trivia every Tuesday I go to with some of my friends, and tonight is whoever comes with the most obnoxious Christmas decorum on wins.
I think you will be towards the top.
I like to think so, but some people really take it to the next level.
If you're not, I wouldn't want to be there.
Yeah, when they do that. Yeah. So thank you guys for joining us. We are going to get things started. Brian, we are here to talk about, it's live. We are here on December 23rd, 2025. What stock are we researching today, Stoffel?
Oh, it was a very close one, as you can see right there, but we are looking at PayPal. And we had all of our followers in our newsletter vote on this. Now, Brian, one thing I just want to say about PayPal before we even get into it. I use Venmo, but other than Venmo, I can't think of a time when I've used PayPal in the last 15 years.
Well, our business accepts PayPal payments, right?
There you go.
And I would say that about 20 to 30% of all transactions that go through our company, Long-Term Mindset, go through PayPal.
So I guess I benefit from PayPal.
Yeah. So when we started to offer it as an option, people did start to use it. And I will say that PayPal's fees are much higher than fees we've seen on on a couple of other places, but that's what it is. All right. So getting into this business. So we are going to be researching it, and just know that some businesses are easy to research. Some are hard. I would classify PayPal kind of in the, it's not the hardest company out there, but it's not the easiest company out there. So we would love to know from you viewers watching, put in the chat on whatever platform you're on. Do you own this stock? We would love to know if you guys are PayPal shareholders. Are you a PayPal shareholder?
I am not. And I don't believe that I ever have been. I'm curious. What about you, Mr. Feroldi?
I am not a PayPal shareholder, although I do vividly remember when this company spun out of eBay. I think it was like 2015. The reason to buy eBay was because of PayPal. It was growing like gangbusters. It was one of the only fintechs out there. We've seen a lot more competition in the fintech space since then, but this was the OG company. This is the company that made Elon Musk his first couple $100 million. Yeah.
What do they call them? The PayPal Mafia?
PayPal Mafia.
So I would say it's about an 80-20 split. Great to see that we've got folks coming in from YouTube as well, but 80 don't and about 20% do.
Got it. So while we're here, my name is Brian Feroldi. There are my portfolio returns over the last 10 plus years or so. I have been outperforming my benchmark. And the reason that Stoffel and I can beat the market, we are firm believers, is the fact that we do our research up front. That research builds conviction. That conviction enables patience. And that patience allows you to hold great businesses for the long term. I mean, look at what PayPal has done since it was spun out. So if you invested 10K in 2015, this was worth 80K at one point, Stoffel. And it's pretty much,
that's a trip right there. That's like a round trip over the last, because I would say if you start out with 10,000 in 2015 and it's only $16,000 today, that is a losing investment.
Very much so. It's really lost to the market. So whether or not this company is going to work out, we don't know, but you do need to do the research so you can have the conviction to hold companies like this through the inevitable up and down. So that's what we're going to show you today. We're going to show you how we would develop the conviction in a company by doing the research. We're going to be doing the research with Stock Simplifier. If you've never heard of Stock Simplifier before, it is our tool that we use to research a company from scratch as simply as possible. We're going to go relatively quickly through Stock Simplifier, but just know if you do purchase it, it has a full course that goes along with it. It has some tools that go along with it. You're going to see us use. We have some AI prompts that kind of speed up the process. And we actually also recently added a sentiment prompt to kind of figure out where the sentiment is on the stock right now. So I'm going to get some of those tools open. So here's the spreadsheet tool. I'm going to make a copy of that. I'm going to open up the fiscal.ai. That's going to be the tool that we're going to be using throughout. I'm going to open up our AI prompt database that we have to use those, and we'll be going from there. So let's start with the sentiment analysis, and maybe we'll try Gemini again. That worked out pretty well last time. So let's go ahead and, oops, no thanks. Let's go ahead and enter the sentiment prompt.
We do have some people that there's no love lost when it comes to the sentiment. We got a YouTube user who says, I hope it goes to 0 and they go out of business.
Okay.
Bad experiences.
Interesting to hear that. Ire for PayPal. Okay, so overall takeaway, PayPal experienced a volatile round trip in 2025. Early optimism around new leadership and Venmo monetization drove it to the 90s.
I don't know if you remember, but they got a new CEO who basically promised the moon right off the bat, and I think that was not wise.
Oops. But persistent concerns over competitive pressure from Apple and Stripe, combined with weak revenue guidance, led to a steady decline back to the $60 range. Its next earnings are in February, so the outlook is neutral. So analysts are neutral on it. Investors are bearish on it. They're very confident that investors are bearish on it. The media is kind of mixed on it.
What does it say? Just up a little bit. It said something about, there we go. The sentiment shifted from turnaround hope to a show me story. Okay. Yep.
I'd say that's pretty accurate.
Yeah. And I would say too, like this is just going through my X feed. This is the stock that gets called out the most as like crazy undervalued right now by certain accounts.
Yeah. So its PE is 12, way below its long-term average. Bulls say Venmo monetization is here, and pay with Venmo volume is going up. They also say buybacks are here. The first dividend and plans to return 70% of free cash flow via buybacks, and it's undervalued. Bears say competitive displacement is losing market share to Apple Pay, Stripe, and banks. Weak revenue guidance, low single-digit revenue guidance suggests it's a mature business. And user engagement issues, active user accounts, and engagement trends have been moving in the wrong direction. So I would say that's a pretty good sentiment overview.
Yeah, that matches the vibes that I see.
Yep, for sure. So we want your opinion. The way we start this is, which of the 6 stages of the business growth cycle do you think PayPal is in? Is this
be interesting?
3, 4, 5, 6? Let us know in the comment section below which segment, which phase of the business growth cycle you think PayPal is in. We do have an AI prompt that helps us to figure this out. I'm going to make a copy of that and put that into Gemini. But I'd love to know what viewers think before we kind of see what AI says.
I mean, I would say that if I had to guess, 5 is the average.
Okay.
And then I would say it looks like there's equal numbers of folks saying 6 and 4.
Okay.
And that's interesting. You know, I was actually responding to someone in my community recently that was talking about a different stock, but they were like, you know, when I put this in, it says 6 and 4. And I was like, you know, that kind of makes sense, because if you're in 6, desperately trying to get out of it, you could appear as a 4, because if you do start turning that ship, then your profitability can go up faster than your revenue. I'm curious to see what they have to say.
All right. Well, AI says it's in phase 5, capital return, and it's very highly confident in that. What's the evidence? Operating income is positive and growing. Okay.
We'll check that.
revenue is growing 6% per year. That might be a little bit too high, but and then it's buying back stock and has a dividend. It just initiated a quarterly dividend. That means that the most useful valuation metrics are price to earnings, price to free cash flow, and reverse DCF. The company is mature with stable operations and capital returns. Current earnings and cash generation drive value, and don't use growth multiples or forward multiples. Hey, that's a interesting thing that it's
Never seen it do that before.
Not accurate. It's not accurate, but
at least they're trying to draw some pictures.
Okay. So what they're doing, they're focused on efficiency and shareholder rewards. They're transitioning the shift from high growth fintech to a mature financial utility. I would say that is accurate. This says focus on free cash flow and price to earnings, like trailing PE, because the business is stable, and watch the capital return program.
Would you be willing to pull this up? I would love to see what this looks like on Fiscal AI, just because this is a really tough one. And I always like to look at the revenue and just see where it's been over the last 10 years and operating income. Those are the two things that I like to look at the most. So, I mean, I look at that and I could see late stage 4, maybe early stage 5.
Well, revenue is still growing. So
right. But I see it starting to plateau. Although last 12 months, okay. All right. I could see stage 4 there.
Okay. So let's look at revenue growth rate. So this is revenue growth. So it was in the mid-teens and 20s, and it's just been declining about 5% in the most recent
what
period.
about operating income?
If we look at quarterly, though, break it out quarterly. So the low was Q1, about 1% growth, but in the most recent quarter, 7% growth. So
it's not terrible.
This is not a stage 6 company, for sure. If we just look at operating profit, though, so there was kind of a peak. Oh, that's quarterly. I want annual. Annual.
I mean, I look at that and I say stage 4. Now, that being said, Brian, we had to create the prompt to say that if there are significant dividends or buybacks, then it automatically says it's stage 5.
Yep.
But I look at that and I say stage 4 because to me,
I would definitely say stage 5.
Now, why would you say stage 5? I'm curious.
Because even though the company is showing some operating leverage, because operating profit is growing faster than revenue. To me, it's a matter of what are you doing with your operating profit? Are you just plowing it back into growth? And is that leading to revenue growth? To me, then you're in stage 4. If you're saying, and management is saying, we're taking that operating profit and we're just giving it back to shareholders, that to me is a stage.
Okay. I see what you mean. See what you mean.
So, and if we look at the,
I would still go stage 4, but your reasoning makes sense to me.
So if we go to the shares outstanding, so this is, are they buying back stock or not?
That's pretty good. 2% per year.
Yeah. So they used to have 1.2 billion shares. Now they have 987.
If you pull that back to just the last 3 or 4 years, yeah. What is that? Wow.
-6%.
That's crazy.
So they are really ramping up buybacks. They're buying back about 6% of their stock on the last 3 years basis. So, and they just initiated a dividend. They haven't paid it yet, but they just initiated it of 14 cents per share.
And for what it's worth, off of what Christian just said, like, how do you account for them paying their employees in shares? If you look at the shares outstanding, that does account for that. So
sure does.
That 6% reduction per year is swimming against the stock-based compensation. So they really are plowing a lot back into that.
I'm definitely saying capital.
No, you've convinced me. You've convinced me.
But this just shows there is some nuance to it, right?
Yeah.
And it's there is nuance between phase 4 and phase 5. I would say phase 5.
No, you've convinced me. I agree. I agree.
Great, cool. Glad we're on with that. Okay, next, what does PayPal do, and is this a good business? I think we know what PayPal does.
Well, I think there's stuff behind the scenes that might be surprising.
Sometimes you might be surprised when you run this prompt, what you learn about a company and how it makes money. I'll also look at some of the key metrics on fiscal, because I like to take a look at that too. All right, PayPal is a global technology platform that enables digital and mobile payments on behalf of consumers and merchants worldwide. It operates a two-sided network at scale, connecting millions of active accounts across more than 200 markets. Its core mission is to democratize financial services by providing tools that move and manage money safely and effectively. Okay. How does it make money? PayPal earns revenue through transaction fees based on total payment volume.
Now, those are the fees that you were just talking about at the beginning of the show.
Correct. It also generates revenue from other value-added services, which include interest and fees from credit products and referral fees. So transaction revenue is 90% of revenue, 29.1 billion. These are fees charged to merchants and consumers for processing transactions. So let's say you buy something from us that costs like $100. PayPal typically takes about, I think, 2% or so. So $2 goes to PayPal, $98 goes to us, essentially. So they take, that's how they take it, which is a pretty standard thing for fintech companies. Okay. Other value-added services are 2.7 billion, 9%, and this is revenue from credit products like Venmo and PayPal, interest on balances, and strategic partnerships. Okay. Who are the customers? Dual-sided marketplace of 429 million active accounts. 393 million are PayPal, Venmo, and Zoom users, which are sending money to friends.
Is that Zoom? Is that a buy now, pay later?
No, that was a remittance company. So country to country payments.
Got it.
And
like Western Union.
They got bought out. Yes, like Western Union. And then there's merchants, 36 million, businesses of all sizes.
Like us.
Like us. Yep. So we're one of the 36 million merchants. Where does it operate? 57% of revenue is in the US. 43% is in international, with Germany and the UK as the strongest international markets. 200 markets, though. All right. How often do customers buy? Engagement and high and increasing. As of late 2025, the average PayPal account has 61 transactions per year.
So that's like one a week.
Yeah. That's grown from 40. I'm guessing that includes Venmo.
Yeah.
I mean, I use Venmo all the time.
Same here. I'm in a football betting pool every week. I spend
ditto. Indicates while the total number of users has plateaued, the remaining users are using the app more frequently. Can it raise prices? PayPal faces significant difficulty.
If we're going to get to this, this is why I don't invest in it.
Intense competition from Apple, Stripe, and Adyen. Evidence shows that its transaction take rate has faced downward pressure and decreased to 1.64%. Management has pivoted to a profitable growth strategy focused on transaction margin dollars rather than raising fees.
In other words, more volume, less take from each
What happens in a recession? It's highly recession sensitive because of its revenues directly tied to discretionary consumer spending. A typical downturn leads to slower transaction volumes. In 2025, the tariff chaos, it slumped. Oh, so that's why the growth rate slowed. That's interesting. The company generates significant cash flow and can continue to buy back stock. So, okay, now we know a little bit about PayPal. So how often customers buy? This is a recurring product. Can it raise prices?
Saying no.
I would say it would lose customers.
Yeah, I would have to agree. And we'll get to the Moat question in a second, because that's the $7 billion question.
And what happens in a recession? I don't think it was all that. We saw the revenue pretty much grew every year. I don't think it's highly cyclical. I would call it kind of
say normal. Yeah.
Normal. But let's take a look at some of the key metrics on fiscal. So if we go to financials, let's turn that off. Let's go to segments and KPIs. So US revenue versus they break out UK, or they used to.
Well, they stopped doing that a while ago.
Yeah. So let's see, UK versus.
That's international versus US.
US. And if we stack those, so let's see, international is growing 13% per year. That's still growing. 16. The US is growing about, well, that's over a longer time frame. It's more recent that matters, right? International is growing 7%. US is growing 6%. So they're still both in growth mode.
It's not terrible.
Okay. Let's look at active accounts.
I mean, that's really important. I mean, they have really stagnated. And I mean, they have really stagnated.
So don't forget that, there's some COVID pull forward, right? And then there's but 430, this number hasn't grown in years, right? So, okay. So new account growth is not, new customers are not really a source of growth. Total number of payment new accounts. Number of payments per active account. It was 37, really gone up. It has dipped recently. So engagement has gone down at least a little bit in 2025. That's something worth keeping an eye on. And then finally, the take rate.
I mean, that's everything.
Yeah. So it used to be 2.4%.
Can you back that up even more? I'm just curious. I remember, Brian. Wow. I mean, look at that. I remember I went to a Motley Fool in-person meeting and I was discussing this company with our friend Simon Erickson. And he was like, why don't you invest in it? Why don't you invest in it? And I kept saying, I just don't think that they can keep their take rate where, like, I just, I don't see the moat.
Yeah. So is there a limit to this? Is this going to zero, or will this kind of flatline and they'll kind of milk out their users? If I was an analyst, this is the thing I'm paying attention to, right?
Well, can you answer Robert's question? Because it's a great question. What is take rate?
Take rate means for every dollar in transactions, how many pennies become revenue for PayPal. So it used to be 3.4 pennies for every dollar in sales became revenue for PayPal.
So if I bought Stock Simplifier for $100, there would be $3.90 going to PayPal.
Right.
But now it's $1.70.
So now
half.
Even if they doubled volume, their revenue is the same because they're now taking less and less.
That's a good point. Would you be willing to just pull up total payment volume real quick?
Of course.
And at the same time,
okay,
both of those things, because that's the trade-off, right? Yeah, that's it. There you go. So the question is total payment volume growing fast enough to account for that? And you know, that's,
I mean, look at total payment volume went up 10x. This is in the trillions, right? So if they can get this number to stabilize, I think they'll be quite happy. But this is where the competitive pressure comes in, right? And anyway, that's interesting to see. All right, so what do you guys think? Do you guys think is this an attractive business? So red, no, it's not an attractive business at all. Yellow, it's good. It's not great, but it's good. Or then green, this is an extremely attractive business. That's kind of how we red, yellow, green in Stock Simplifier. So red, I'm confused. I don't get it. It's not a good business. Yellow, I understand. It's perfectly fine. Green sounds like a great business. What do people think?
Well, Robert says green. We've got Santo and John saying no. We've got a bunch of yellows. Neil, Jacques, Tony. Got a red here on YouTube. Some more yellows and reds. Yeah,
so yellow.
I would say a reddish yellow. Yellow is probably the average.
All right. Well, we'll say yellow. I would say it's a fine business. It's not a spectacular one.
You know, this is fair. Look at Christian saying to me, it's like a cigar butt. It's a reference to Warren Buffett and how can I not remember Warren?
Charlie Munger?
Not Charlie
Benjamin
Munger.
Graham.
Yeah, Benjamin Graham. Kind of like there's value there, but it's not growing anymore.
All right. So we went with yellow. By the way, the Stock Simplifier, if you scan the QR code, normally costs $199, but if you want to get access to the course, all the tools we're using, all the AI prompts we're using, $99 if you use the link that Brian Stoffel is going to share in the chat.
Yeah.
Okay. Next, moat. Does PayPal have a moat? So red, yellow, green, does this company have a moat? So there are 5 different sources of a moat. There's network effect, switching costs, low cost, intangibles, and counter positioning. There's a current moat direction. What is the current state of the moat? And then the most important one, I would say, is what is the direction of the moat? Is it shrinking? Is it stable? Or is it widening? So I would love people's opinions right now. What do you think is the current source of PayPal's moat? If you had to pick one, is it the network effect? Is it switching costs? Is it low cost production? Is it intangibles like the company's brand name? Or is it counter positioning? I would love your opinion, Stoffel, first. I would say, do you think, which of these sources do you think is the most important for PayPal?
I think the most important is probably network effect. You know, the easiest way for an everyday person to understand this is just Venmo, right? Like, I am able to participate in my weekly football pool because I use Venmo and the person I'm sending my $5 to uses Venmo as well. And everybody else needs to use Venmo. So it is valuable because everybody uses it. I think that there's probably some switching costs in there as well. But I think the network effect is probably the most important one. The problem is that I'm not sure it's not an exclusive network effect. Like I go to the I go when I go to the when I go to the store, I see like 5 different things that are offered right there for me to pay for something. So it's kind of like, sure, network effect, but at the same time, that doesn't keep the competition at bay.
Yeah. So I'm gonna say I'm gonna disagree.
Okay.
I'm gonna say it had a network effect.
Sure.
I don't think that is a source of moat anymore, because there's a network effect from Apple to Apple users. If
Right,
you're Cash
exactly.
App, there's a network effect from Cash App to Cash App. So to me, a moat is only a moat if it keeps competitors out or it keeps competitors from doing something. This used to be when it first came out, PayPal was the only way to send money electronically. Right. Now you have lots of options. So I'm actually going to say it's switching costs.
Yeah, I like
once you're kind of set up on it. You know, you're not going to really switch away, or if you're going to check out, you're not necessarily going to switch away from that. But I don't think there's never a wrong answer, but that would just be my initial interpretation.
Yeah, it's like what Scott says. You and I are over 40 plus year olds just don't want to change, or they just trust Venmo, and so they're not going to. I agree with you. I think now it's more that.
All right. So AI says their moat is narrow and stable, network effects and switching costs. PayPal maintains a significant competitive advantage through its massive two-sided network effect. It does have a huge install base, right? Sure. Which remains the gold standard for online checkout. However, increasing competition from one click like Apple Pay and Stripe prevent this advantage from using a wide classification, and as evidenced by a stagnating active account base growing only 1 to 2%. So network effects, it says, are present and stable. It's a two-sided network effect. However, the flywheel is slowing. Total payment volume is up slightly. Active accounts are modest. PayPal's network is the evolution of e-commerce, but now faces headwinds as competition comes in. Switching costs are present and stable,
but narrow. So narrow for both.
Narrow. Yeah. There's technical integration for the loss of PayPal-only shoppers. Yeah. As I said, when we introduced PayPal to our checkout options, our conversion rate went up. So there are some people that just want to check out with PayPal.
I'm curious, Brian, can people pay with Apple for our product?
Yes.
Okay.
Yeah.
And do they use that?
Yes.
Okay.
Yep. Transactions per active account, all that's out. Okay. Intangibles, they're narrow and they're stable. PayPal has a very strong brand name. It's synonymous with safe online shopping. I totally agree with this. Yep. It says it has a 45% market share. I don't know where that number came from, but it does not command significant premium pricing anymore, and it's lowered its take rate to stay competitive with Stripe and Adyen. 4.1. So it says you
go down. If you go down, it'll tell you what it is at the bottom.
It's not a low-cost producer. There's no counter positioning. It used to be a counter positioning, but it doesn't have that anymore. And Morningstar says narrow and stable, and analysis is narrow moat. So I would agree with the AI here and say number 1 is switching costs, number 2 is network effect. But if I was to be grading this, I would say it's narrow to stable. But you might convince me that it's weakening with the competition kind of coming in.
Yeah.
But I'll go with yellow for now. Yellow for now. Okay, next.
This next one's a big one too.
Absolutely, it is. Does this company have low or negative growth potential, good growth potential, or great growth potential? So thinking through how do companies grow? Well, they either get new customers or they get existing customers to spend more. Based on what we know about the company's growth numbers, we could pretty much say that new customers are not happening. It's very anemic, which means that PayPal, as of right now, is pretty much depending on getting existing customers to spend more with improved retention to kind of grow. Now, if we go to fiscal, we can see that revenue over the last 3 years has grown about 7%, and that's down. Earnings per share over the last 3 years have grown about 36%. But moving forward, Wall Street expects 5% revenue growth and 19% earnings growth over the next 2 years. The long-term estimated growth rate is about 12%. So
they think there's some ringing out that can still happen.
That's exactly what I was going to say. That's very much going to be expense control, modest revenue growth, and then buybacks, basically to get to that 12%. Plus, you get a 1% dividend yield that basically takes up nothing of the company's income to pay. So, what do people think of? I will run the link.
Let's run it and see, because when this comes up. So Jack brings up something I'm curious if it's going to be there about stablecoin, their application to become a bank and collect interest, because there could be use cases for this that become big. And the Genius Act that was just signed, I'm trying to educate myself on. I'm curious if that's going to come up here.
Okay. So new customer acquisition, marketing and sales growth. This says moderate. It's shifted from aggressive user acquisition to profitable growth. Okay. New distribution channels. This says strong. Okay. The launch of PayPal World and the major expansion into Africa, which is planned for 2026, represents new cross-border distribution. Partnerships with Apple and Google Wallets are opening new physical retail channels. That's interesting.
That is.
I would not have known that.
Well, especially because the stable coin is the use case that makes the most sense for it is cross-border payments like Western Union. That's the one that makes. Like a lot of the other stuff is just kind of like, but that one I get.
So geographic market expansion,
which plays a role in this one too.
Aggressively targeting India, China, and Brazil through PayPal World, partnering with local giants to enable 2 billion local wallets to transact internationally. That's okay. That seems like a logical thing to do. I know that WeChat is a giant in China. So partnering with them does make a whole lot of sense to me. Acquisitions, since the 4 billion acquisition of Honey, they've largely paused. That's okay. Existing customer expansion, pricing power. This is very weak. I agree with that.
Yep.
New products or services like one-click guest checkout and Venmo Stash and Venmo Business Profile. Okay. Customer retention is strong. So they're still
really just aren't getting anybody new in the doors.
So new product monetization from Venmo and Fastlane, engagement velocity with keeping account engaged, their core customers going high. New countries like Africa, India, and China, as well as banking services.
And look at that's just within the last 3 weeks. That application.
And then acquisitions are not a major opportunity here. Okay, that's better. The AI identified more than I was thinking off the top of my head. But what do you guys think? Red,
yellow, or green?
Yellow, green. Does PayPal have low/negative growth potential? Yellow would be modest, good growth potential, or green being excellent.
Can I just say, when it comes to that, like cross-border payments, with a stable coin, they need a new name for it. It can't just be PayPal, because people already have an idea of what PayPal is. Do you know what I mean? And so they need something that can go viral and show a functional advantage over a Remitly, over a Western Union.
I disagree, because the name PayPal is synonymous with trust.
But is it internationally? Like, I just don't know.
Well, it said that half of their customers are international, or half of their sales are international. I just think, like, when PayPal got into Bitcoin or crypto a couple of years ago, that to me gave me a okay, that's a trusted way to buy. Versus going with Binance or FTX or any of the other things that have since gone, like getting a major. I think PayPal brings with it cachet and name brand so that people can trust that you're sending it to the right spot. So I disagree with that. But what do people say?
I would say that there was more greens than I expected. There were not
Okay.
many reds, and I would say mostly yellows.
Yeah, I'd say yellow is pretty fair. So, all right, this is a fair. That's about what I would expect for scoring this business. A friendly reminder: if you're watching this, you want access to Stock Simplifier, $99 with the link that Stoffel is going to share in the chat. Next, key metrics. Now, one of my favorite things about Stock Simplifier is the metrics that we look at change depending on which phase of the business growth cycle the company is in. For a company that's in phase 5, the metrics to look at are revenue growth, free cash flow conversion, EBIT to interest expense, return on invested capital, and the capital return program. Now, this is the prompt that AI struggles with the most. So
It's our first time giving it to Gemini, or maybe the second time we're giving it to Gemini.
That's fair. But we'll see how it does, and we'll back it up. Okay. Revenue growth, it says green, 6%.
I think we had 6.7.
Yep.
So it's close.
That was accurate. Okay. So revenue growth is fine. It's fine for a phase 5 company. Free cash flow conversion. This says 113%. This is in financials. And then it's in.
If we just pull up the cash flow statement, we can see it there too.
Yep. And then I think it's in, I never know which one it is. Margins? Is it in margins? Free cash flow to net income.
There you go.
That's it. So 113%.
Hey,
Gemini nailed
it.
That means that it's producing more free cash flow than net income, which is a very good thing. So got that right. EBIT to interest expense. I have a feeling that this is going to be just fine. This says 13. Like, this is a measure of the company's balance sheet health. Is it in financial health? EBIT to interest expense.
We can also just look at the income statement too.
Yeah, that's going to be just fine. We can just,
okay. I'm going to take their word for it. I'm not too.
Yeah. What's their interest? Actually, this makes it a little bit tricky because what is their interest expense? And that's a little bit tricky for financial companies because they also have interest income.
Yep.
Yeah. I'm guessing they don't have any interest expense. Let's see. Cash and equivalents. Do they have any debt? Long-term debt is 11 billion. Okay. So they have a couple billion in long-term
debt. They have about
debt,
equal amounts of debt and cash, roughly.
Not a problem. I didn't think that was going to be a problem. So let's just call that green. Return on invested capital, current value of 17%.
Let's check that.
5-year number, it says, is 6%. That's the 5-year number. But if we go to financials and then ratios,
this one's capital efficiency.
Capital efficiency, return on invested capital. Ooh, this says 20%.
Interesting.
So fiscal says 20%. I'm guessing that's why the long term was wonky. But return on invested capital of 20%.
I would say that's right at a greenish yellow.
That is green. Yeah,
that
would be green. So let's call that one green. And then finally, capital returns. Well, we know that they're buying back stock, and they've been doing so for 5 years. So this might surprise you, but we're going to go yellow, green, 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 green.
Yeah.
Okay.
That doesn't, because we said phase 5, it doesn't surprise me. If it was phase 4, it would have been different, which is important because you got to know what you're getting into.
For sure. Okay. So pretty good on a key metric perspective. All right. Next, let's take a look at the risks and specifically the execution risks. So we believe that all risk boils down to one risk, and that risk is execution risk. What are the odds that PayPal cannot achieve the growth that management is now promising and pricing into the stock?
Have you ever seen it give a score like that before? I've never seen that.
It's saying 2.25. I'm guessing that's 1 out of 3. We did not program it to do that, so that's Gemini interpreting what we're saying, but it's saying medium level of risk. Okay. Severe competition from digital wallets and margin compression due to mixing shift.
Yep.
Offsetting that is the company's huge account base, high trust brand that converts 74% for unknown merchants. Okay. Is concentration risk an issue? No concentration risk at all. Great to see. Is disruption a risk?
Yeah.
Yes. Apple Pay and Google Pay are threatening to be at the operating system level for sure. Personally, if something doesn't have Apple Pay, I don't buy it on my phone.
Look at that stat that comes right after what you highlighted. Can that be right?
I mean, it's double click face ID, you purchase it, right? Even with PayPal, which is really convenient, you have to go to like a different site. Yeah, sometimes have to log in depending on where it is. Like when I'm on flights, I still use PayPal to check out if I want to pay for Wi-Fi, and it is a little bit clunky. Like Apple PayPal, Apple
That's
Pay
like the
is
whole
just so
ball
damn
game.
frictionless.
That's the whole ball game.
Yeah. Well, that's on mobile. It doesn't do that on desktop. Apple Pay processes an estimated 10 trillion in payments. Wow. Apple, no way. I don't know if these numbers are accurate.
I'll look it up while you're doing that.
I in fact highly doubt that they're that high. There's no way they're that high. PayPal's business would be zero if they were that high. Okay, outside force is it a major thing to watch? Absolutely, but I would say I don't believe that.
I'll tell you this: the projection was that it's around 7.6 trillion. We don't know for sure.
Wow.
For Apple Pay.
Yeah, that would be bigger than PayPal. PayPal is like 2 trillion.
Mm-hmm.
So it's 4 times bigger than PayPal.
So if you want to know why PayPal has been a losing investment, look no further than Apple.
Wow.
But it shows you why that international is so important, because Apple iPhones are very popular in the US and Western countries. That cross-border payment, the stable coin, going to Africa, Brazil, what have you, India, that's the shift that needs to. We're building a narrative here using Stock Simplifier of what the company needs to do in order to survive and thrive.
It's the whole Apple turning your business into a feature of my business, right?
Yeah.
It's like, oh, you're a payment company. We also offer payments if you buy the iPhone.
And oh, by the way, my device does everything else in the world.
Competition. And then there's also Stripe. There's also Adyen, unbranded processing that forces PayPal to accept lower margins. I personally use Wise, 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 as a when we pay our international contractors, and their fees are rock bottom.
Like, give me a rough rate, like take rate.
0.25%.
Yeah, like what is PayPal going to do about that?
I don't know. But whenever I make or receive international payments, we go to Wise for it, which is a business that we should potentially research.
Maybe we need to put it on the list.
Them and Remitly, I think, are taking it up. Okay, so taking all of that now, we did talk about their moat and everything like that. So what do you guys think? Red, yellow, green. What is the execution risk here? Red, this is going to be extremely hard to execute. Yellow, it's going to be hard, but the normal level of hard. Green, the execution here is very low.
Coca-Cola.
Yeah, exactly. It's Coca-Cola. It's a utility. They're in such a strong position, and they have such a great execution history that it's not going to be a big deal.
I don't think you're going to be surprised with where a lot of these are. We even got a very red, red, yellow, red, yellow. Potential disruption is driving me to red. I'm definitely red.
Okay.
And this is why I didn't invest way back when, because I was just like, I don't see where the moat is here.
And let's really dial into this. Just because the execution risk, if you think it's red, that doesn't mean it's not going to happen. That just means that the environment and all factors considered require extreme talent by behalf of the management team, and it's just a higher bar to hop over to achieve their goals. Doesn't mean they can't achieve their goals. It just means the risk of them achieving their goals is high.
I like to think of it like the 1980 Olympic hockey team. Could they win the gold before they went into it? That would have been a red. Like,
Yep.
you would not see me placing a huge bet on that. Does that mean that they can't do it? No, they can do it. Just like this management team could do it.
Yep.
But it is a path laden with many obstacles.
Can the Patriots win the Super Bowl this year? Sure, they could. I would put that in the red category. I think that's it's a long shot, and I'm a Patriots fan, and I love Drake May. Okay. So I would say that is fair. Okay. Valuation time. So this is a company that is in the phase 5 capital return. When a company's in phase 5 capital return, the options for us to look at are typically trailing, backwards looking. So price to earnings and price to free cash flow, the trailing numbers.
Now, Brian, we got in a couple questions. Can you just remind folks, what site are you using here? And is the site we're using part of Stock Simplifier?
Great question. This is fiscal.ai. This is not this is the entire Stock Simplifier was built and taught through fiscal.ai. They are a partner of ours, but it is a completely separate product. What we're showing you, I think is the paid one, but we can actually turn off. We can actually go to the free. So if you're not a paid user, this is what it looks like. It's essentially the exact same thing. If you choose to become a paid user like I am, you can, you unlock basically more data, but all of Stock Simplifier was designed to be used even if you just use the free version of fiscal.ai. Mm-hmm. And it's fiscal.ai/Brian if you want to use our link to get a discount on the subscription. But all the metrics that you see are, look at this. You get like 10 years worth of data, I think for free.
Yes, it is for free.
This is free. This thing I'm showing you right here is the free version of fiscal.ai. So everything that we've done so far, you can access for free, which is why we love partnering with them. Okay, so PE time. I'm going to push this graphing line right here and go middle. I'm going to go low. I'm going to go high. So this is kind of the midpoint. I would say that it's probably best to go between 2023, roughly, to get an accurate. And if we go quarterly, to get a more accurate look, geez. Yeah. When do you think of the good?
I would go to September. Yeah. Around, I mean, man, that's tough. I was going to say October 23.
All right. Yeah, that's probably fair. Okay. So this is the last, call it 2 years when their stock has been kind of in the doldrums. So it's traded at an average about 16 times earnings. It got as high as 28 times earnings. Currently 11.8. It's trading at 11.8 times earnings. Okay, that's metric number 1. Metric number 2 is price to free cash flow.
This should look even more appealing based on what we saw before, that free cash flow is higher. Yep. There it is.
So if we go to price to free cash flow,
real quick, Brian, because this is a great question from Cass. We just eliminated, like, we have 10 years worth of history and we just eliminated a bunch of it. How do you make that decision?
You have to go from a reasonable time frame. So basically you have to be like, when did the story change? So this stock was back here, it was being valued like a high growth, 15-20% grower.
Using Llewellyn's terminology, what's the anomaly we're eliminating here?
So
COVID.
I don't think, exactly. The COVID, when Bubblicious prices were peaking, when the growth numbers looked like fantastic. If you use this as a comparison to kind of figure out, is it a value or not? Of course, it's going to look dirt cheap because this valuation was unsustainable. This was assuming valuation was a high growth. You have to go during a period that is actually useful in comparison. So when did PayPal get re-rated to be at a lower growth company? I would say that didn't happen until October of 2023. Also, there's sometimes when you do this, and you see a big spike or a big drop in the numbers because earnings were artificially boosted or artificially pulled back by things like a tax rate or a one-time
Write down.
balloon payment, acquisitions, that kind of thing. And that just throws off the data. So this is the tricky part. You have to find it does take some nuance to kind of figure out, well, when's an actual accurate period here for us to judge when these metrics are most useful. So we're just trying to use our intuition to kind of figure that out. Because you don't want to say, oh my God, it's 10 today, but it was 70. This is 90% undervalued.
Right.
The narrative is completely different.
Right.
Yeah. So that's why it's a little bit squishy. So currently 9.9 times free cash flow. It looks like it got to about 8 times free cash flow. This looks like when they revised their guidance as it picked up before. So 9.9 times a free cash flow. Brian, I hinted about this in an email, but I do want to show you this. If we go to shareholder yield.
I was actually going to ask you to pull that up. Can you pull up the component parts of that as well? Just the buyback.
Well, first off, let's talk about what this is.
Yeah.
So shareholder yield is, everybody knows dividend yield. Dividend yield is dividend payment divided by market value. So if you buy the stock price today, what's like your interest rate that you're earning in dividends? Shareholder yield is the exact same concept, but it also accounts for buybacks and debt payments. So if a company is paying down its debt, that's like a return to you, the shareholder. If it's buying back stock, that's a return to you, the shareholder. Meaning if you buy this stock today, you're earning a 12.3% yield on the market cap. Said differently, if instead of returning capital via dividends, buybacks and debt restructuring, if it devoted all of that money to dividends, your dividend yield on this company would be 12%.
And look, it's hard to find companies that have a shareholder yield that high. And we know why, right? Like, because before, Brian, you pulled up their shares outstanding and we saw that it's been going down by like 6% per year over the last couple of years. I mean, that's bonkers.
That's when it was here, right?
Yeah.
That's when it was trading here. And now essentially they can retire 12% of the stock every year. All right. What do you guys think? Is this valuation attractive? Red, it's overvalued. Yellow, it's fairly valued. Green, this company is dirt cheap, very, very undervalued.
I'm curious, Brian, when you ask this question, do you just think of the valuation or do you try and marry that with what we just found out about the company itself?
Oh, of course, the two things go together.
Well, but the only reason I ask is, so pull up the stock simplifier page. It's like, if we look at that, you know, like I would say green, if I'm just looking at, you know, I guess what I'm saying is when do you just do valuation and then pull it all together in this bottom line? Are you interested?
Yeah, exactly.
Do you get what I'm saying?
Yeah. So how do you think about this? I would say that the market is not stupid, right? The market is largely correct. The market, I would guess, largely agrees with our assessment, which is it's a good business. It's not a great business. It's not a horrible business. It's a good business. Its moat is in question. There are serious concerns about its execution risk. And because of that, the market is valuing this company for death. It's valuing the company as if growth is gone forever. Low single-digit growth is like best case scenario. It's valuing it as if its move into China, into India, into Venmo checkout is going to fail miserably, as if the stablecoin thing is going to fail miserably, and the take rate is going to go down. That's what the market is like assuming with the stock price. So the bar from a valuation perspective that it has to clear is fairly low, but we just said that even clearing a low bar is going to be hard to do.
Well, right. So that's the thing, right? It's almost like visually I look at this and I'm like, well, there's just one red and there's a bunch of yellows and greens. The thing is that one red that we have, that's not a small thing. That's like maybe the most important one.
Right. If a business is truly disrupted, and well, that first off, if the business was truly disrupted, that would mean it's in stage 6,
Yeah.
right?
Yep.
The trailing numbers do not indicate it's in stage 6 yet.
Yeah.
But if they start to swing and go in the other direction, look out below.
And we know.
Yeah, right. If the market says this business is permanently impaired, it won't be priced at 10 times earnings. It'll be priced at 5 times earnings.
Now,
right?
Brian, here's what I love about Stock Simplifier. I think of it as a way to say, what's the story with this stock? And then, I'm not going to make a decision to buy or sell based just off of this. But then I go and I research and I say, do the numbers digging even deeper support this story? So if I had to come up with a story right now, I'm in the elevator and they're like, tell me about PayPal. What I would say is it's a stable business that is being rampantly disrupted by Apple Pay, and they're trying to fix it by moving internationally. That would be my elevator pitch.
Yep. I would say that is spot on. All right. So taking everything into account, everything that we just covered, would love your opinion. Red, yellow, green. Are you interested in this company? Red, nope. I am not interested at any valuation. Yellow, the risk is worth it. Maybe I'd add it to my stock, but valuation really has to be correct. Or green, you think that the market is way over worried about the disruption risk and the growth risk, and you think that the install base and the things that have their moat will protect the company, and you think that the returns that you'll get from here will actually be pretty darn good. Would love to know. What are people saying?
I would say reddish yellow.
Reddish yellow?
Yeah,
Okay.
This is like when you got a nosebleed and a cold at the same time.
Where are you?
I'm red.
Red?
But let me just say that valuation, that yield is very tempting to me.
Sure.
However, I don't have industry specific insights. So the stable coin and the opportunity abroad, if I knew something, if you know something about that and you have faith in it, that's a difference between you and me, which matters. But I would also say that I think that in the end, you gotta have a strong moat if I'm even going to consider you. And I don't see it.
Well, while we're here, let's take a look at Wise. This is Wise. This is the company that we like to use.
Mm-hmm.
We go annual. This is Wise. This is the company that we use for payments. It does look like their growth.
Now, let me just say something about that LTM. That's not fair. So their calendar year ends in March. That only includes like 6 months of growth in that LTM number.
Oh,
so
it did include 12 months. Last 12 months. LTM.
No, I know, but there's only 6 new months that are included in there. So there's a lot of if it's a Venn diagram, the March 25 and the LTM, there's a lot of overlap there. So it says 9.9, but pull up the trailing, pull it up on a quarterly basis.
Well, here's the growth rate, right? This is saying growth is 9%.
So now go to a quarterly basis, and I bet you over the last 4 quarters, it's over. Well, that's pretty close to 9%. Really flatline there. It's interesting how it takes a step down every 2 quarters.
Yeah. I think that was pretty accurate. I thought this number was just going to be crazy. This is growing, right? This is definitely taking market share from it. So
I wonder how it's valued.
What?
I wonder how it's valued.
Well, real quick,
the same
17 times free cash flow.
So not quite as cheap as PayPal, but
this is forward. This is forward. I assume this is a growth company. 24 times trailing. This says 1.2 times free cash flow. That's not correct. About 4 times sales and about 17 times free cash flow. Yeah, how is this stock done? If we go 10K growth. So it came public in 2021. Awful time to come public. But been pretty much dead money so for a while. So okay. All right.
I would say most people are not interested.
Okay. Well, that's why we do this. Whether
Yeah.
or not you're interested or not, it's important to know how to research a company. And if you are going to take a bet on PayPal, I don't think you're crazy. And I do think there are legitimate reasons to believe that you could earn a decent return. You just have to go in eyes wide open and say, what is it that the market is seeing that I am overlooking? And I do think there's reasons for optimisms. There's reasons for pessimisms. I'm going to put this in my too hard bucket. I'm not much of a cigar butt investor. I'm not much of a turnaround investor, but there are reasons to invest in this stock. There are reasons not to. I see more risk than upside personally.
Yeah, and I think what Pablo said is so true. It's the most upvoted comment that we have too, which is the real question is, are there better places to put your money? I think the answer is yes.
Yeah, for sure.
Yeah.
Cool. Well, thank you guys so much for joining us. We hope you enjoyed this deep dive into PayPal. Are you banging? You are muting now.
There's some work in my basement. That's all.
Oh, okay. Thank you guys so much for watching and joining us. Next week we are off, but we will be back in 2 weeks on Tuesday, January 6th. With another episode of Stock Simplifier. We're going to be putting out a poll on Wednesday, the 31st, to figure out what stock you want us to research next. So we would love it if you could vote in that and join us to figure out what kind of stocks we could be interested in heading into 2026. Thank you so much for spending some time with us. Happy holidays, Merry Christmas, Happy Kwanzaa, whatever you celebrate. We hope that you have a great end of your year and a prosperous 2026 and beyond. See you then.
Bye, everyone.
Brian's out.